Part 2. Commercial Banks and Other Financial Intermediaries. Now that you have a better understanding of what money is, let's discuss financial intermediaries, institutions that move money from those who want to save it to those who want to borrow it. Most financial intermediaries are depository institutions, normally called banks. Depository institutions are financial intermediaries that, by law, can accept deposits in transaction accounts, and that together make up the banking sector. In a nutshell, depository institutions accept funds from depositors and loan these funds out to families and businesses. A bank loan is called a tool of indirect finance, as the bank intermediates between lenders, the depositors, and borrowers, loan applicants. The banking sector of the United States has 3 distinguishing characteristics: an unusually large number of small banks, a dual nature where some banks are chartered at the state level while others are nationally chartered. It's one of the most heavily regulated bank sectors in the world. The U.S. banking sector was greatly shaped by the nation's history. American historical wariness for centralized power led to the unusually large number of small banks that still operate in the country, as, up until 1927, banks could be chartered only at the state level. Starting in 1927, with the passage of the McFadden Act, banks could be chartered at the national level. However, the act subjected national banks to their home state branching rules, effectively prohibiting interstate branching and severely limiting interstate banking. The limits on interstate banking were later lifted by the Rigel-Neal Interstate Banking Act of 1994, which relaxed branching rules and started an era of bank mergers. The heavy regulatory environment typical of the U.S. banking sector is a consequence of the duality of the system, as well as an inheritance of the stock market crash of 1929 and the wave of bank panics and bank failures that followed in the 1930s. In response to the financial upheaval, Congress passed the Banking Act of 1933, often called the Glass-Steagall Act, which imposed limitations on the type of activities that banks could engage in and on the interest rates they could pay on deposit accounts. Also, since the banking sector is dual, most banks are regulated both at the state and at the national level, and they are subject to supervision from state and federal agencies.